Our next guest is pretty bullish on the regionals for 2026. Erika Najarian, UBS senior equity research analyst focusing on the large cap banks, joins us this morning. Erika, happy Friday. Good to see you.
Good to see you.
I was going to ask you whether or not the environment can get any better, but I think you probably think it can.
Look, I mean, especially for the regional banks, right? They have really suffered from all of the market share loss in direct lending to the non-banks. And last Friday, the federal agencies essentially pulled back this leverage limit standard that they've had in place since 2013. And a lot of the regional banks had blamed that as much as prudential regulation for a lot of the market share decline and loss to some of these non-banks. So I think that's good news for loan growth. We have a steep yield curve and likely probably getting steeper depending on who the president names as Fed chair. You know, credit quality is still quiet and you're seeing activity levels really continue to be strong. You know, additionally, we have started to see bigger deals in the space. And so I think it'll be the year where the regionals may start to join their money center brethren in terms of the rally.
Right. As for the big guys, do you think all of their, I mean, such a banner year, are all of those gains baked in, or are capital markets going to impress us even more in 26?
I think capital markets are going to impress us more in 2026. I do think that some of that is already priced into the stocks. I mean, clearly what the valuation is saying that they're not just anticipating higher capital markets activity levels, but also continued deregulation. So I would be precise when it comes to money center banks. I think it's too early to reduce exposure, but if you want to add in money center banks versus regionals, I think you have to be a little bit more stock selective. And we do continue to like Bank of America here. You know, Bank of America has underperformed 250 basis points relative to the other money centers since it's an investor day. And for a cheaper valuation, you can get everything that you want in a money center bank: the capital markets activity, you know, the margin expansion, you know, the buybacks, all for a much cheaper starting point from a valuation perspective.
I was listening to you lay out the case for the regionals, which makes a lot of sense in a strong economy. But why haven't we seen all of that stuff happen this year? I mean, shouldn't loan growth be better than where it is?
That's a really great question. Actually, it hasn't relative to the money center banks. So the money center banks have done a lot of indirect lending or non-depository financial institution lending. So as opposed to directly lending to the company, they lend to the fund that lends to the company. And that has been a big fuel of outperformance of loan growth for the money centers. In addition, the consumer continues to be pretty strong. And so that's translated in credit card growth. And that's simply a money center catalyst and not a regional bank catalyst. So as we think about some of the provisions in the big, beautiful bill that's supposed to drive increased CapEx, and again, you know, I can't emphasize enough how much this sort of leverage lending limit getting pulled, you know, could be a factor for next year. I think that's where you start to see direct lending catch up. Additionally, if the yield curve is steep, then bank balance sheets could be a better, cheaper solution than going to the debt markets in terms of financing.